Good evening and welcome to our October London South East Natural Resources webinar. For those of you who don't know me, I am Donald Leggett and I'm Head of Investor Relations at London South East. And I am your host for this evening. We're joined tonight by 4 CEOs, at least 3 of whom may well be familiar to the regulars in our audience. We start with George Lucan, CEO at Angus Energy, who celebrated first gas a few weeks ago and are now busy increasing the volume and capacity of gas they can deliver to the national grid. Then we cross the Atlantic to hear the latest news from Arthur Millholland, President and CEO at Canadian Overseas Petroleum Limited, better known as COPL to you and me. I'm looking forward to hearing from George Bennett, CEO at Rainbow Rare Earths. Yesterday, Rainbow published the preliminary economic assessment for the Rare Earths project at Phalaborwa in South Africa, and the economics are stunning. So do hang around for them, they're third. And finally, we speak to Stephen Key, CEO of Labrador Uranium from Canada. I'll tell you why you should hang around for them, because uranium is mainly used to power commercial nuclear reactors that produce electricity and for medical, industrial and defense purposes. And a supply-demand uranium super cycle is forecast within 2 years. And yellow cake, because that's what they call it, yellow cake is at give or take at a 10-year high right now. There you go. Have I convinced you to hang around for the 4th company? I hope so. As usual, each presenter has 30 minutes in total to make their investment case, with 20 minutes talking to slides before we take your questions and put them to the speakers. The London South East bulletin boards are a large part of the investment landscape in the UK, where we provide free data and a moderated space for investors to discuss the merits of the companies they invest in and follow. So please jump on the Angus, the COPL and the Rainbow boards tonight and let us know what you think of the presentations. I can see George holding his head in horror there, going, no, don't do this. Only say nice things, guys, only say nice things. And if you want to buy stock in Canadian companies like tonight's Labrador Uranium, or for any of our previous Canadian miners, then the interactive investor trading platform will allow you to trade in Canadian listed TSX and TSXV stocks, and you get some really good quality businesses on there, so well worth a look. And we do this all over again on Tuesday, November the 8th, when we bring you another 4 companies, each ready to make their investment pitch. Okay, it's time to hear from tonight's CEOs. Here we go. A brief introduction to Angus Energy next. As if they need an introduction. When Angus Energy CEO George Lucan answered your questions on London South East just a few weeks ago and got a terrific reaction, he described Saltfleetby as a gold mine. And why? Because flow rates are due to be ramped up to 6 million cubic feet, or scuffs, in October. A second compressor will be installed in December, which hopefully takes flow rate capacity up to 12 million cubic feet in January. Yeah, you heard me right. 6 million cubic feet up to 12 million, in January and beyond. And a potentially massive sidetrack well is due to spud in October, which is where the differential in gas comes from, I guess. It literally doubles the amount of gas. George Lucan is here to put all that in context. Welcome, George.
Good evening, Donald. Thank you very much for that glowing. I'm blushing here, blushing. Glowing welcome. Why don't I go straight into a snapshot of Angus as it is. We've got a little presentation, it's not very long, and we'll whistle through that. We've called ourselves here engineers in energy transition. That sounds slightly highfalutin. What we really mean is we're pragmatists. We're not theological about any particular source of energy or means of getting it to people in industry. We're merely skilled engineers. And we'll do the best we can in an ever-shifting policy environment and perhaps an ever more difficult climate environment. Going on, just as background to our current shareholder base, following the acquisition of the rest of Saltfleetby earlier this year, we've actually got quite a nice mix of free float and some long-term supportive investors. Forum, you see there, the big blue chunk, they sold their 49% interest to Angus for 6 million quid plus these shares here. So they're quite interested. They believe they sold at a considerable undervalue. They were pressured by cash calls. and we believe we've got a fantastic deal, but they're very interested in actually seeing that value finally hit the share price. It's not to say they won't take some off the table from time to time, but we regard them, at least for the time being, as reasonably long-term shareholders, and there's a degree of lock-in there as well. And there's Aleph, who helped led our loan facility recently. They also led a fundraising to support that acquisition, and alongside them, there's a number of smaller investors you don't see here, perhaps totaling another 5 or 10%, or each of them below 2%, 2 or 3%. And lastly, now properties who've been in there since IPO and are again long-term structurally supportive shareholders. So this is a great foundation for growth, to have a nice mix of good liquidity, nice free flow, retail interest, and some core shareholders. Moving on. What are we? Well, most of you guys will be familiar with the old Angus. It was 3 small oil fields in what was a great wheel play of the last sort of 10 years. It hasn't ended well for most, but we're going to aim for what we call modest barrelage from those sites. It's 50 to 150 from at least Brockham and Lidsey, and hopefully a little bit more from Balcombe if we're successful at appeal, which we're still waiting for the inspector's report on. But the big thing, of course, was acquiring back in 2019 half of Saltfleetby, indirectly from Gazprom, of all people, and for little more than £1. In fact, we were given some money to take it off their hands. And yes, it turned out to be much more of an endeavour than we thought it did, but we have got there now. And in August, we announced first gas. So we're flowing at about 1.5, a little bit more, million therms, 1.57. That's about 5.5 million scuffs a day, and standard cubic feet. The field's got P90 reservoirs. That's a very high probability of recovery of 180 million therms. And as you all know, the price of long-term price of gas per therm is about £2. So it's a very valuable reserve. And in addition, we've got contingent resources in the southern half of that field, which we've not addressed, of another 120 million therms. So it's a great asset. It's connected directly to the national grid, and our buyer is Shell. So in some ways, it couldn't be more vanilla than this. We've also, in the interim, we weren't idle. We have been genuine in our aspirations to add some alt energy into here. This isn't greenwashing. It's very passionately held by some of the junior members of staff and indeed our technical director. And it's a large geothermal program we're planning in Devon. It's going to take time, but it's an exciting prospect, and I'll just touch on that briefly. So last year we actually managed the reconnection, and this year the plant came online, and just in advance of it coming online, we were able to acquire the other 49% of the field from Forum. And just a little table there of the deal that we did. Now, back in October 2021, we had a competent persons report which valued our field. You see here the top left-hand column at 25 odd million. Now, given we're 50-50 roughly, you can see that you have a field there worth about 50 million, and our effective purchase price all in was about 14 million. So it was a massive discount, and if you include the wider reserves, it's a 62% discount. But that was on the basis of October 2021 prices for gas, and they were looking ahead 3-4 years, about 62 pence a therm. Right now, you're looking at it more like 220 pence a therm, so perhaps more. So you've got a fabulous deal here. We were very, very lucky, and it tells you why Forum will want to stay in there for the duration and get to see the value reflected in the share price. Just a quick update on what we're doing. We are doing a sidetrack later this month. We're beginning the spudding it later this month. That's not actually going to open up any new reserves, but it will accelerate our ability to get them out and get them to grid and turn them into cash. And hand in hand with that, we have a second compressor, which will enable us to take, as Donald pointed out, the field capacity up from about 6 million scuffs a day to 12. So that will essentially mean, in cash terms, we'll be chucking out well over 3 million therms a month, Now, if you say we were able to achieve, and it's entirely pie in the sky, and accept that, £2 a therm, the prices we'll come on to later, that's of course, for half of that is unhedged, you're getting £3 million, and then you're getting probably another £750,000 for the hedged element, at least, and you wipe out the debt and indeed any contingent payments to Forum in about 6 to 8 months. That's will be hopefully debt-free and partner-free within probably the middle of next year would be a good estimate. Assuming gas prices hold, and we are successful with this sidetrack and the new compressor. We're also going to reperforate Brockham, lift the oil production there, we hope, to about 150 barrels a day. And we're going to proceed with some seismic expenditure in Devon on geothermal. It's a long-term project, but you've got to do this work. The second sidetrack, we're all aware of a government levy, so 91 pence in the pound that we spend on drilling, exploration, development, and such like, we get back by avoiding this levy. So we're going to go ahead and get after those resources now while this tax is in play. So we envisage a second sidetrack in the latter half of next year, and that would be to target these extra 120 million therms. So there you go. That's the basic snapshot. Just while I've got time, I wanted to go over some of the background in terms of prices. This is a forward price graph, so it's telling you what the price was for gas this winter at different times over the last 18 months. And you can see when we did the CPR on the left-hand side back in October 2021, price was about 60 odd p a therm. For this coming winter, it's a little bit more, 70p there. As you can see, it's risen and risen and risen steadily. Now, the big spike at the end was the French and the Germans trying to fill up their storage, but underlying that is just a generalization of how tight the market is. So you're looking now at a winter 2022 price of about 400, 500 pence a therm. And a summer 2023, because you might well say, well, that's just this winter. Well, the summer 2023 is not a lot better. It's still around the 400 odd mark per therm. So it's telling you that structurally, the whole of Europe has a shortage. I think it had a shortage before the Russians turned off the tap. It's just an extreme shortage now. What's the read-through for our geothermal aspiration, and indeed for everyone else's green projects? Well, there's fantastic news in a sense, because a lot of green projects that didn't make sense at the old wholesale price, which was 4 or 5 pence a kilowatt hour, you're now looking at, well, it's 20 pence today, but at least you can see they're probably 15, 16, 17 pence as a kind of long-term run rate. So this is very good news. Geothermal at 4 pence a therm was a stretch, it was a struggle, but at 17 pence a therm, it's a no-brainer. You've got to go do it. It works, so long as we can get access to grid. And I've shown this here in this graph. I won't go into any detail, but it's the IRRs and our sensitivity to price per therm. And you can see as the price heads up toward a sort of 10 pence per kilowatt hour, you're getting nice sort of 20-25% IRRs. It's very good on such a long-term utility style project. It's very, very good return, and one that people will queue up to fund. And I think this, I'm closing with this. It's a generic. I've used this slide before. Essentially, you've got 3 big sources of energy in the UK. You've got, in terms of fuel consumption by source, oil, the big blue one there, gas, the green, and electric, which again is actually about 40-50% gas, the yellow. Now, the problem we have as a country is that we want to shift to alt energy. We're by and large shifting via the grid, via the electric side of things. So you've got to basically put as much of that blue and some of that green into the yellow bit. So in effect, you've got to double or almost treble the size of our distribution and transmission grid. I've given you some examples of public projects here and the kind of timeline you can expect. There's high-speed 1, the Channel Tunnel Rail Link and so forth. 10 years, 11 years. High-speed 2, well, we're already up to 10, and I very much doubt you'll see completion for another 3 or 4 years. The Viking link with Denmark, well, we're up to 6, 7 years, maybe another 3 or 4 years. If you want to see the kind of staggering changes in the transmission and distribution grid, you've got to be looking at a bare minimum of 10 years. So our view is that these prices are here to stay, and what we have to think about, so we move on to what do we do, Angus, what does Angus do, is how we can actually remain relevant, how we can do good things even in that difficult environment. Obviously, further hydrocarbons do make sense, particularly gas. As you can see from this particular slide, that government policy and the environmental lobby have combined, perhaps wholly unintentionally, to create some of this crisis. And we have really none but ourselves to blame for these high prices. You know, there's no institutional capital really for hydrocarbons. We've seen basically the industry stall in terms of new fields and new development, and we're paying for it now, both in higher prices and dirtier energy. But I think what we can do is we continue to maintain oil and hydrocarbons because, as pragmatically, we must do. I think we build up geothermal projects, but we're aware, and we have to be aware, that the biggest obstacle for us all is to get that energy into a distribution system, into a grid, in effect. And the third aspect of our growth pattern will be in storage, I think, because it is around storage and incidental entry and exit from the various distribution grids, both the liquid and the electric grid, where small players like ourselves can make a very significant difference in the long run and make good commercial money. I mean, everyone's focused right now on the gas, and I think that's right, but I still think electric behind it, alt electric will be good, and storage will be fantastic.
Oh, that was terrific. Okay. So the question I'd like to ask is, what difference will the second compressor make to the potential capacity in January? Tell us all.
Well, right now, we are almost touching 5.7 million standard cubic feet a day. So I'm quite comfortable we get to 6. So that's off one. Now, the second one is a clone. So what we're able to do with the first, we should be able to do with the second. So getting to 12 million standard cubic feet of capacity will be easy. What's the capacity if the sidetrack is moderately successful, not even as successful as we expect? Say it was only to deliver half of the hoped for flow rates, I think we could still do 11 on the back of that. If it delivers the whole lot, we can clearly do that for 12 of capacity. If it's a complete duster, I think the existing 2 wells could still do 7, should still leave us more than covering the hedge, paying down debt, and we would not lose any value as a company, but we would lose the time value of addressing these reserves much more quickly. That's the aim of the sidetrack, and indeed of the second compressor. It's to monetize the gas more quickly. It's not finding new gas. I think that's an important point.
And I appreciate this is a slightly tricky question, given that your capacity is heading upwards at the moment. But how long will it take for you to clear the company of debt?
If we are successful with the sidetrack and this capacity, the second compressor works, I think all the debt will vanish within 4-5 months of the year end, which is when we expect the second compressor to be installed. So yes, it will go really very, very quickly. I mean, we are already paying it down. So we'll make an announcement at the year end at the calendar year end on the status of that.
And likewise, you actually own 100% of Saltfleetby, but nevertheless, you're a part of the deal. Part of the sale proceeds are paid in gas to the seller. So when will that threshold have been reached And when will that, I suppose, debt in a sense, when will that have been paid off and be behind you as well?
I would hope by sort of June, July of next year. Again, on the basis that if you have about 1.5 million of unhedged, 1.5 million tons of unhedged production, and you manage £2 a therm, then you've got £3 million odd. So you've got that for 6 months. You've got £18 million, and
George, you're popular. We all want a bit of George, that's for
we've
sure.
got £18 million then of free cash flow. So we had 12 million of debt. We've got rather less than that already. And you've got 6 million quid to pay for them. So yeah, you can get rid of the lot by July.
Fantastic. Well done. Oh, don't worry. We all have children. We all have interruptions. Think of it as a blessing rather than a distraction.
Yeah.
It's fantastic that someone actually wants to spend time with you, George. Believe me.
Well, yes, you've got a point
there. Richard Timmons asks, is the sidetrack fully funded?
Is the sidetrack fully funded? Yes. There's contingency elements to a sidetrack. If it runs on for an extra 10 days, I couldn't say that for certain. But to date, we look like we're going to cover everything. Yeah.
Okay. Which takes us very neatly. Well done, Mark Stevenson, because the next question flows beautifully. George Lucan, you're a very experienced man in your field. You are, I can vouch for that. Can you explain to us less than mortals how the spudding of the sidetrack goes, how it works, and how confident you are it will go without hiccups? So if you could give us the time frame and some of the detail on the sidetrack, please, George.
On the sidetrack, well, we're spudding, we hope, I believe, on the 20th. We're going to use the moment to shut down temporarily because we've got some regular maintenance we want to do. And lifting the rig is the one risky or dangerous part of the operation. Everything has been meticulously planned now for 2 years. That's not to say that drilling is always with risk, as I'm constantly reminded by my stern technical director. But it's a relatively simple operation. We're going down an existing well. We're breaking it at a fixed point, and we're going off at a relatively small angle initially. And then that angle bends out as we move toward the reservoir. We're going to take not a huge length in the reservoir, about, I think, 350 to 400 meters of the reservoir is horizontal. The issue you have, one of the big difficulties, is that this is a partially depleted reservoir. So you don't have the natural pressure of the gas around you, which means that if you just flood the reservoir with heavy oil-based mud, whilst you're drilling, then you lose a lot of that mud into that reservoir because there's no pressure forcing it back. So we're having to use interesting fluids, much lighter, foamed oils and so on, in order, in fact, a particular chemical mix, in order not to damage the reservoir as we go through it. I'd say that's the more complicated bit. There were a few instances just above the reservoir. There's a coal-bearing layer, which is prone to collapse, and which our predecessors suffered at the hands of and lost downhole equipment and so forth. We're quite aware of that. We go at it with our eyes open and very careful planning. So I wouldn't say it's a high risk well, but I'm going to be absolutely straight. All wells have issues. And no drilling program is absolutely flawless. So we go at it sanely and sensibly. It's quite wrong to say that this field presents many greater difficulties other than the fact it is partially depleted. So you have to be careful with the balance of your drilling, as it were. What muds you use.
Okay. Well, we wish you all the very best of luck with that, because it makes a heck of a difference to Angus Energy as a whole, doesn't it? It changes the economic outlook entirely.
It changes the short-term economics. Now, remember, if we sit there with these 2 wells, it'll take twice as long, but we'll drain the reservoir. But this thing allows us to really suck it out fast, put it that way. So shareholders see it up front faster. That's the value of it. But the actual gold mine aspect, or the analogy that you reminded me of, that remains the same. those 300 million therms that are there, or rather the 180 that are there on the P90 case, they're there for us, win, lose or draw. At least there's a 90% probability from a competent person that they're there. But we'll get them a lot faster if we get the sidetrack. Yes, everything happens faster.
Mark Stevenson says, with over 12 million cubic feet coming soon, will you be pumping gas through Thettlethorpe? Thank you.
Pumping gas through Thettlethorpe. Yes, we already are. We're the Thettlethorpe National Grid entry point, which is next door to the old Thettlethorpe refinery. Yes, I can tell him that the gas is whistling down that pipe and into National Grid's fancy facility. The refinery, of course, has gone, completely gone. It's a greenfield. So
how far are you guys actually from Thettlethorpe?
About 8 or 9 kilometers.
Okay, and the gas is whistling through Thettlethorpe as we speak.
It is indeed. It is indeed. It actually moves quite slowly, funny enough. But
going slowly through Thettlethorpe. Oh, that's not quite so romantic. Okay, Egbert Wilkins. As Angus will soon be turning a substantial profit, hopefully in the near term, can you explicitly rule out any further share placings?
No. I've never been able to do that. No.
Okay, and what's the reason for that? You would be raising money for future projects?
Yeah, or indeed acquisitions or whatever, or if there's, I'm not going to go around and say we're never going to raise money, because that's just not. No CEO can say that, can they? I don't know. Do all CEOs often say, "Oh, we're never going to raise"? It
depends whether they're telling the truth or not, George.
Well, I don't think I could go that far.
Okay, you mentioned the most interesting M&A word. Is any M&A on the horizon, or is that you just want to get Saltfleetby settled before you
Well, I'm also racing on, because although we're covered for this first year, I think get final advice from taxmen, but we're probably covered for this energy levy for the next year, this coming year. But after that, we'll still be making roaring profits, and I don't want to be giving 25% of away to government if there's something useful I could be doing with that. So are there farm-ins out there with our brothers in oil and gas here or elsewhere? Yeah, I'd go for that. Occasionally, might that mean a corporate combination? I wouldn't even write that one off either. We'd certainly like to be active. There's no point us paying this tax if we could be drilling a well and adding new reserves and resources for shareholders in the future. You
want to be making your money grow.
Yeah, absolutely. Yeah, get
okay. This question comes from Nahim Mia. Apologies if I've mispronounced the name, by email. If the sidetrack isn't a success, heaven forfend. If the sidetrack isn't a success, then would the hedge continue to be covered with the existing wells and still make a profit?
Yes, the answer is, but in for 3 or 4 months it would be tight. But we know we can run these 2 wells much higher than 5.5 million scf. So I think we comfortably go up. We had one of them running at 11, but that's in initial conditions. I think we comfortably make 7 or 8 million scf, and that would cover even the slightly higher hedge payments in the first part of next year, and then the hedge payments tail off. So yes, we would, but it would be slow going, and I've said that. It's no loss of cash value, but in terms of time value of that money, that would be what would be sacrificed.
Okay, my final question from the audience, Mark S. Bad Mark, you haven't given us your surname. Mark S. In East Africa, there's a geothermal risk mitigation facility to help pool geothermal drilling risk, with government helping fund that. Is it an equivalent in the UK? And he's not sure if that's for Angus.
There is and there isn't. There's a bucket of subsidies, in effect, auctions for green energy. And I think geothermal, they were offering, maybe it was £120 a megawatt hour, 12p a kilowatt hour. Well, the price is somewhat better than that in wholesale. So I don't think the program of subsidies that the government has kept up with the change in the pricing environment in the wholesale markets. But they have been in contact with the Renewable Energy Association. There's a geothermal group there. We do talk to the department regularly through that group. and there's a possibility that the subsidy situation might evolve into something like the French do, which is a good dry hole insurance program, whereby the government will pick up some of the enormous costs of drilling to these depths. So yeah, if that answers the question at all.
Yeah, I think it does. So final question, this one from me. Where do you see Angus Energy in 2 or 3 years' time, George?
I see it as being a larger entity, a more liquid stock, and one that is paying dividend. I mean, definitely that for me is the one value that the shareholder can expect from a company they have a stake in. So I'd also like to see it as diverse and playing not necessarily in the big league, but adding value, being a relevant part of the energy landscape in Western Europe in particular.
Okay, fantastic. Well, let's call it a day there. George, it's been a pleasure having you. I'm so delighted for you that things are going well. I realized the 3 years to get to this, you've been an overnight success, but the last 3 years have been tricky. So well done to you, and thank you for joining us this evening.
Donald, thank you.
It's always a pleasure, George. Okay, and on to COPL, our second company of the evening. Those familiar with London and Toronto listed oil producer Canadian Overseas Petroleum, or COPL, probably know they have producing oil assets in Wyoming and have recently bought further P1 and P2 reserves from their bankrupt partner CUDA at advantageous terms. Joining us live from London, I was thinking it might be Calgary or somewhere exotic, but Arthur's joining us live from London to talk us through the assets and their potential. Here we are, President and CEO, Arthur Millholland.
Well, good evening. Start again. Thank you very much for having me, Don. And
it's an absolute pleasure. It's been a while, and yeah, what a transformation you made of COPL. Well done.
Well, thank you very much, and we got a lot more to come. So
good answer.
So just strap yourselves in.
Okay, audience, are you strapped in?
And anyhow, I think we got quite a number of our shareholders online here this evening.
You certainly have.
So for those who haven't really seen it, this is a photograph of our plant facility at the Barons Flat Shannon unit in the Powder River Basin of Wyoming. And those actually aren't trees in the background; they're windmills, and there aren't many trees here, so it's basically what it looks like. I think first off here is that, this year we thought in 2021 was a transformative year. This one really was even more so for us. And so the map on the right shows our acreage position in the Powder River Basin, mostly in Converse County, and we have 3 units. We have 85% of the Barons Flat Shannon unit, which are working interest. We're the operator, which is an early stage miscible flood. And the Coal Creek unit, we have 100% of Coal Creek. And there's an exploration unit called the Barons Flat Federal Deep unit. We have 85% of that. We're the operator. And as well as a number of non-unit lands in between that we have 100% of. Right now we have a 40+ year reserve life, and the oil production is inclining rather than declining. And this miscible flood primarily coming from it, a little bit of oil coming from Coal Creek right now. And the facilities were all built and commissioned in late 2019, and really the gas injection got going in February of 2020. And our current production, we're working on wells and optimizing, but right now it's around about 1,600 barrels a day, as we announced in August. Some weeks it's higher, some weeks it's a little lower. We've got 40.5 million barrels of 2P reserves before royalties and 31.3 after royalties. And of course, we're listed in Canada on the Canadian Stock Exchange as well, here as a standard listing on the main board of the LSE. Those of us who follow us know what we did in 2021, but we just put it in here for people that don't know who we are. But we got all this done in 2021, bought this field when when nobody could go out and borrow money in the oil business, and we did in March of 2021, and here we go. But what we stated earlier in the year were our objectives for this year, and that was to complete the consolidation of the interest in Wyoming. We did that. We had a bankrupt partner. We purchased their assets out of bankruptcy in the United States, and that closed in July. Our next objective is to refinance our U.S. Affiliates credit facility, and primarily to reduce our cost of capital, get a better lender, optimize and increase our oil production at the Shannon unit, and we're doing that here right now. Commence the phase 1 delineation of our deep oil discovery we made last year. And of course, you know, to continue to maintain our current ESG operating credentials, which they're quite envious, because we get most of our everything's electrically powered. We get it from a wind farm, and we really don't flare a lot of gas. Normally we don't flow any. Last but not least is to restructure our hedging program. The consolidation of the assets at the end of 2021, our 2P net present value at a 10% discount rate was $258 million. Post the acquisition of CUDA at the end of July, we had an updated reserve report done, and that's increased to $492 million. We purchased CUDA's assets for $19.15 million, and we financed that with a $25 million face value convertible bond, which the majority of which is actually held by a large institutional shareholder here in London, who was our largest shareholder then, still is, and we would call them our cornerstone investor. They're very much happy behind us and continue to support us. The next page is here. If I'm quoting reserve numbers under our regulations in Canada, I've got to put a page in from Ryder Scott, and so there's what they were on December the 31st at the end of last year, and here's what they are here at the end of July. For all of those, I would ask that the definitions of the reserves are in this report in the back. In Canada, we're subject to Canadian regulations. They're much different than they are here or in other jurisdictions. For example, proved reserves in Canada there's a 90% probability that the recovered volumes will exceed the amount, which is much different than a P90 case here where it's up to the amount. And that's because of scandals in the past in Canada 25 years ago, and the rules are pretty stringent. What we're working on here right now is refinancing of our credit facility. Now, in March of 2021, we borrowed $45 million from a credit fund, a large U.S. credit fund in Boston, to finance the acquisition of Atomic Oil and Gas, which was the operator of all of this. And most importantly, there are no guarantees on this money with our parent company, which is the public company, nor are there any warrants or anything else from the public company. Anything to do with, there is a warrant on the subsidiary company, but it's a cash payment, you know, over time. It's based upon the increase in value. We've approached a number of U.S. banks to refinance this. We have strong interest right now from at least three, and all of those three that are well known to us and ready to deal with us. Now, this can take either in the form of a straight reserve-based lending facility or a senior loan, depending on how it's structured. But the key thing we'll call that both would be senior. A senior facility would be to retire the current $42 million that we owe the credit fund. We did pay them $3 million at the end of July, and potentially also restructure our hedges, which are swaps. Now we have We'll talk about those later, but we have purchase swaps on butane and sales on crude oil. And right now, the net cost to buy those out would be about $10 million. We're also looking for a junior facility which is like a revolving facility to provide us more operating flexibility, and as well as looking for CapEx, to convert our proven undeveloped reserves to proven developed producing. And we have a substantial amount of proven undeveloped reserves. The key thing in doing all this is the reserve report. Ryder Scott is one of the top two of the independent evaluations engineers globally. The other one is Petroleum in the US. They've evaluated 100% of the reserves of our company. We have an updated report as the effective date at the end of July, which we received in September. We also have resources other than reserves, which Ryder Scott has done, both in contingent resources and prospective resources, covering a deep discovery that we made here in last year. But one of the things that a lot of our shareholders forget is the sunk cost to date of the businesses that we purchased. So to build this miscible flood, for example, there was a total of $141.6 million gross invested to date, of which the net interest that we have represents $120.4 million. And that's a combination of drilling, $68.6 million for drilling, and the production injection wells, $26.7 million for the facilities, $46.2 million for the miscible injectant. Now, before we closed the transaction to buy Atomic, they put in 1.1 billion cubic feet of gas into the reservoir, enriched gas. We've put in to date 3.2 billion cubic feet from April 2021 to present. And when I say we, because we were carrying CUDA, through the whole thing. Now that's an asset. It's not reflected in our reserves. It's not considered to be reserves, but it's in the reservoir. And if we look at the heating value of that, it's about double the heating value of pure methane. And so at current prices, it's worth about $78 million today. It was injected at much lower gas prices. We're also go to a bank and say, well, most look at us as a single asset company. If we look at things, we're actually a 3-asset company, and we'll talk about Coal Creek here in a moment. We've got the Barons Flat Shannon miscible unit, the Coal Creek unit, and our deep unit. The Shannon unit is a miscible flood. It started really the production at the Shannon unit on primary. The first well went on in 2016, but the vast majority of them came on in 2017, 18, and essentially it went right to enhanced recovery right from the start. And it's one of the few in the world that did that. Usually they would water flood it in between. Our 2.22 million, we have 22 million barrels of proved reserves split almost right down the middle between proved developed producing and proven undeveloped. The majority of our proved developed reserves are at the Shannon unit. The rest of them but the PUD reserves are split equally between the two. And primarily either it's the Shannon unit or Coal Creek, the risk is actually mechanical, rather than a reservoir. In other words, a mechanical risk to drill a horizontal well to develop it. We also have 18 million barrels of probable reserves. Those that are there at the Shannon unit are recovery factor related to the miscible flood, and in the Coal Creek unit, it's actually lands offsetting the proven reserves. We also have significant contingent resources offsetting the 2P reserves at Coal Creek, and that's an awful lot of upside. And that's not even talking about the prospective resources we have on the deeper discovery. Now, the key thing is in talking to a bank is what I have here on the screen is actually right from Ryder Scott. It's at the end of last year. It's the same forecast production curve that we've had previously, and the issue is primarily to start with the Shannon field is how do we get it, see the real ramp up, and there's total proved, which is a solid line. No, excuse me, the proved, current proved producing, total proved, which is little squares, and the proved plus probable. So what we're working on here right now is to debottleneck the Shannon field, and that's primarily we're facing here right now is that the gathering system to gather the gas, because all the produced gas we produce from the wells is gathered and sent to the plant and compressed for reinjection for the miscible flood, and it's coming back in certain wells at much higher pressure than was originally simulated, and so it's under design. And so we have a simple design for that. We're seeing high pressure trends in the reservoir. It's just to build a high pressure system to gather the gas and take it back to the plant and leave the existing system as a low pressure system. And we can do that for relatively very cost effectively for about $2.5 to $3 million. We'll have to add some additional compression at the gas plant and build some more injection lines to convert some injection wells on the western side of the field. We have 9 additional wells to drill in the PUD area to increase the production, and also 1 or 2 injection wells, and a whole bunch of PUD wells to drill in the Frontier 2 at Coal Creek. So this is just a schematic of my sketch of where these pipelines are. They're actually going to follow existing right-of-ways. We have an application right now, to flare some gas to ease it, but we can get this done fairly quickly once the permits are in hand. And that will take the load off us. We have between 300 and 800 barrels a day of production restricted from certain wells because we just can't access the facility with it, and we're not actually allowed to flare large volumes of gas. We can flare a little bit, which we have temporary permits to do that. We're looking for an expanded permit until the pipeline is built, but that will help us go a long way. Just illustrating where the PUDs are in the Shannon unit or on the fringes of the field, but the core area of the field is in the center, is what's being produced here right now. But the key thing people don't really look at us is what we have here at Coal Creek. And our discovery well that we drilled here late last year in August, September. Don't see my cursor. It was right down in the corner here. And so, but there's a producing field at Coal Creek in the Frontier 2. This is the Frontier 2. So the green lands are proven reserves at Coal Creek and proven undeveloped. The yellow lands are probable reserves, and of course there's various C1, C2, and C3 contingent resources, which are orange, pink, and blue. So this is a significant resource, and if you look at the curve in the forecast production curve, what it says of the total proved plus probable case is the Shannon field with the recovery factor plus all the drilling on the yellow and green lands here at Coal Creek. It doesn't account for anything else, and it's just south of 10,000 barrels a day, just a little bit less than that. In addition to the Frontier 2, there's also proven undeveloped locations in green in the underlying Dakota, which we're producing from here right now, as well as probable reserves in yellow plus contingent resources. But one of the big things we've been working on, and seems to be the topic of discussion on your boards, is what are we doing to optimize the production in the Shannon field? Well, I've talked about our gas, our pipeline issue, and we've talked about that in press releases and our disclosure. It is restricted. We're flaring right now just under 1 million cubic feet of gas under temporary permits from several wells. We're trying to balance the field. And don't forget, any gas that we flare, we've paid for, because primarily it's injected. That's coming back through the wells. It's not solution gas. It's butane-rich methane. But we made an application to flare up to 3.5 million cubic feet per day, and that comes in front of a hearing in Casper, Wyoming on the 11th, and we expect to get it. Now, it's not to say that we're just going to go flare 3.5 million cubic feet per day, but one of the things that we want to do before, well, in the final design of this pipeline that we're making, is to turn these wells right up and actually see what they'll do rather than calculate it. Now, this flaring, we think, will unlock about 300 to 600 barrels a day of production currently. So that will take us to around 2,000 barrels a day to 2,600, or 1,900 to 2,500. And those are in line with the curve that we see from Ryder Scott of where we should be. We've also tied in some wells directly into the gas plant, one, and we did this past summer, and we've got permits in hand from the surface rights holder to do 2 more. And again, that will debottleneck our gas gathering system, and they're short tie-ins, like they're not very far. But the other thing is we're seeing is a real increase in the production in certain wells to the movement of the miscible bank. And when I say that is that we had expected under the simulations that when 3.2 billion cubic feet of gas was injected, which would have been about late last year, that this bank would have started to move, and it actually didn't. And we put a third more gas in it since then, and now it's starting to move. So we see low producing wells literally flip over to high producing wells. We've got 5 flowing wells in the field right now, and 27 pumping wells, and the pumping wells start to flow through the pump, and then eventually we have to take all that out and convert them into pure flowing wells. The other thing that we've noticed here is this oil is paraffinic. It's got a little paraffin in it, as all oils do in this basin in Wyoming. And normally this paraffin would come out at between 1,500 feet below the surface and 4,000 feet, but we found it right down to the perforations at 7,000 feet, and it shouldn't do that. So we're doing some analysis in the lab, but we really believe that the miscible front is actually changing the chemistry of the paraffin, and that's fine. We know it's there. We can't explain it, but we're dealing with it. And so rather than use hot oiling, we use condensate, which is really Mother Nature's gasoline, and it's extremely easy to get rid of paraffin. Most people don't use it because it scares the daylights out of them to pump this stuff. But on the other hand, our produced crude out of the flowing wells is much more volatile than the paraffin is, because the butane is trained in it. I mean, not the paraffin, the condensate. And because of that, we use it for hot oiling, or used to, where we take some produced oil, heat it up, put it down to melt the wax, and they were happy to pump that. They're happy to pump this. So we tried 5 wells in early August as an experiment, and they all worked. So we've been methodically going through the field to treat every well in the field, and it takes some time, but we're also reliant on outside services. We were from pressure pumping to do that. So we went out and bought our own pump, and on a unit, it's mounted on a trailer, and we take it around, but it took us about a month to get it, the manuals, the safety manuals, as well as get it certified under pressure pumping under the U.S. Occupational Health and Safety. So it's actually out in the field and working, and it cuts our costs way back. Again,
okay,
it's
Arthur, I need to ask you to wrap up there, please. Thank you so much.
Alrighty. Well, I've just got I've got schematics of the pumping and flowing wells, of how we treat them. People can read them, and looking at how most importantly, how the production has jumped up in one of these wells, and that's typical of what we see. But last but not least is our deep discovery. And we've permitted a number of wells on it for drilling. But most importantly here, we put press releases out, and interestingly enough, we were approached by a large, listed oil company in the United States, inquiring whether or not we wanted a joint venture partner. And it was at a very high level approach, and they would be a very good partner for us to have. So we're still in discussions with them. This is an enviable piece of acreage that we have. It's 50,000 acres, just under. We have 100% of the vast majority of it. We operate it. And most importantly, they know what we found, I believe, from the way they're talking with us, because the vast majority of the information that we've used to map this, other than the well that we drilled, is in the public realm. So we'll see how that goes, but it's extremely encouraging. Given the size of this thing, we can't do it ourselves. It is too big. And what our intention is right away go into a secondary recovery on patterns, and that's the way we can maximize the depletion of the reservoir. And we would do it in stages as we go all the way through. So let's all stay informed. We look to have a loan agreement with a bank, hopefully a term sheet for that in the near term, and hopefully on finding a partner here. I would like to do that this month as well. We've put back the drilling until January because of just rig availability. We still can't buy any casing, but they have casing, and away we go. Once we get our production in the field stabilized, and it's not stable right now, it's just bouncing around. We're working on wells. We'll update the market at that time. So sorry for the lengthy presentation, but I haven't given one like this for a while.
So sorry, Arthur. We've only got 5 minutes for left for questions, and we've got lots of questions. So let's try and answer things concisely, and we'll crack on.
Sure.
Sam Boole says, could you confirm who you're looking at doing a JV with in January? That's the JV that you were mentioning. Is it possible that, or is it commercially sensitive, that one?
Commercially sensitive.
Thought it might be. Likewise for Sam, will you be doing any more placings?
Nothing planned.
Nothing planned, there you go. Clyde Gaster, how long will these permits take to get? Are they long lead items?
The permits on the wells are with the Bureau of Land Management, and we have a number of permits in hand. And so, the reality is the only thing that we need is 15,000 feet of 9 7/8" casing. How's that? And
you're still trying to get hold of the casing?
Yep.
Okay, that's very good. Greg Thompson, what's the current barrel BOPD? What's across all your fields? You've got 3 main assets. Across all those main assets, what's your current output?
As I said earlier, right now it's about 1,600 barrels a day, but tomorrow it could be 1,700. And as I say, when we work on these wells to do the condensate treatments, read the presentation. A pumping well takes about 5 to 7 days. A flowing well takes probably about the same, because we've got to basically shut it down and turn it back on. And so you don't really have a stable month, if you see that, or a stable week. And we've got some wells that have flipped on us, and we have a service rig on right now. So it's not like old declining production where you got a decline curve and you can tell next week where you're going to be. What we do know is that it's going up, and we've got a handle on all the issues that we've faced here for the last couple of months or 3
Great.
months.
Tying into that, Jim Anderson, who's a long-standing shareholder, he says he notices that the recent update on the Wyoming oil and gas website shows that oil production has increased by around 11% in August compared with July. Are you pleased with this performance? And do you expect production to increase incrementally through September, October, and beyond?
Yeah. Yes, I do. Yeah, we're pleased. And certain times during the month in August, it was much higher than that. Yeah.
Fantastic. And it's on an upward curve. Fantastic.
Mhm.
Second question from Jim. Are we any closer to finalizing the RBL deal? And can we expect it to be signed off this month?
We're in discussions with banks here right now, and anybody that's dealt with a bank says that you don't want to walk in too eager, but we've got an excellent asset base, and we're targeting to get a term sheet here this month so we can draw by the end of the year. And so
you mentioned 3 different banks.
Yeah.
Are you narrowing that down to one and then getting them to
out of the 3, all 3 are very interested, but we have one bank that we deal with on a daily basis, really just with our cash. They've already done their KYC on us. They know who we are, and they lend to the oil business. And they would be our preferred bank. Yeah.
Okay, good answer. And yes, Paul Brown, another pre-atomic long-term holder. The winters are quite harsh in Wyoming. How do you think this will affect the drilling program and the development of the topside infrastructure?
No, it won't affect it all at all. I come from Alberta, Canada. The winters there are maybe a little harsher. We've got a drilling rig that's fully winterized, and it's easy to operate in the wintertime. You just have to know how to do it. In fact, more wells are drilled in Alberta in the winter than they are done in the summer.
Oh, interesting. So is it actually easier in the winter?
In some respects, yes, it is. Yeah.
How interesting. Who would have thought?
No,
Final question.
No mud, yeah, ice. Yeah.
Final question for you, Arthur. You'll be relieved to hear. When is the drilling rig likely to be on site, and when do you think we'll hit 2,000 barrels of oil per day?
We're targeting January to have the rig on site, and we believe we'll find casing by then. The market is starting to loosen up. It's all been caused by the war in Ukraine, believe it or not. Shortage of oilfield tubulars globally, and the cost is more than double right now. So that's our target. As far as the production goes, I think I've explained where we are and when we expect it in the presentation.
You have indeed. You have indeed. Arthur Millholland, President and CEO of Canadian Overseas Petroleum Limited, better known to us as COPL. Thank you so much indeed for sparing your time. Thank you for that presentation. That was really fantastic. Thank you.
You're welcome, Don. I encourage everybody to read it because there's lots in there, and it answers most of the question, the emails and the text that I get, and certainly things that people are.
Guys, don't bother Arthur. Read the presentation, please.
Exactly.
There you go. Was that okay?
Perfect.
Thank you so much, Arthur. We really appreciate your time. Thank you.
You're welcome. Yep. Bye-bye. Bye.
Bye-bye. And on to Rainbow Rare Earths. Sorry for making you wait a wee bit, George. No doubt it's well worth waiting for. Don't disappear. Listen to Rainbow Rare Earths. George has got a lot of fantastic stuff to say to you. Yesterday, AIM-listed Rainbow Rare Earths published the preliminary economic assessment. I can't say it, but it was very impressive. The PEA for the Rare Earths project at Phalaborwa in South Africa. As expected, the economics are stunning. Rainbow is using new technology to extract rare earths from gypsum. A production of over 26,000 tons of separated rare earths is predicted, generating 3.6 billion of revenue over 14 years. That's a lot of money. George Bennett, CEO at Rainbow Rare Earths, joins us live from Johannesburg.
Good evening, Donald, and to all your listeners and viewers. Thanks very much for the introduction. Donald, I just want to correct you on one thing. We're not using new technology. The technology is well proven. It's the way we've put it together that's unique and that we are patenting. So it's a very important distinction because...
Your technology comes from Florida, doesn't it, George?
Yes, but it's been applied commercially in numerous industries and in numerous countries around the world. So
has it been applied in gypsum stacks before? For rare
no,
earths?
but the as I say, the technology is proven. It's just the application that is different. It's not new technology, very different. So okay. I just wanted to clarify that.
Very good. Over to you, George.
Thank you. I need to share the screen here, don't I? Can you see my screen? Just to go through the disclaimer, as you can all see that there. and straight on to the key numbers of our PEA. I'm very pleased to announce very strong PEA numbers yesterday, and this is on the result of sort of 20 months of work since we secured this project in late November 2020 and really started working on it in January 2021. And now we sit in October 2020, and we've been able to develop a flow sheet that's economic and that has been proven at lab scale. And as I say, a very important distinction: every single part of our flow sheet has been used in mineral processing in some form or another. And it's just the way we put it together, which is unique and which has been patented. The back end is already patented with K-Tech, the technology company in Florida, America. And the front end that we've co-developed is also undergoing a patent as we talk at the moment. So to get onto this slide, as you can see, on our base case scenario, which is a very conservative pricing that we've used in our financial model, the project's got an NPV of $620 million, a very, very strong IRR of over 40%, very, very good EBITDA margin of 75%, and we've got a payback of 2 years. If we had to use year-to-date prices for rare earths, that's from January 2022 to September 2022, we've got a NPV of almost $1 billion and an IRR of over 50% with a margin of over 80%. And these are this EBITDA margin, I believe, is the highest of any rare earth project in the world, and a payback, of less than 2 years. So very, very strong numbers. Also, importantly, we've used a conservative discount rate of 10% in our model. We could arguably use an 8% discount rate because this is actually a chemical processing plant more than a mining project, which would even improve these numbers. But we've been conservative with our pricing and the inputs into our model to show that it's a very, very robust project that we have here. We've also got one of the lowest operating costs per kilogram of separated magnet rare earths, which is, I think, will be one of the lowest of all Western rare earth projects in the world. The only real project we can benchmark ourselves against is the Lynas rare earth operation in Australia, which is obviously, as you know, in production, one of the biggest operations in the world outside of China. And they, like Rainbow, go all the way through to separated rare earth oxides. And their cost per kilogram is significantly higher than Rainbow's. And in their best year to date, their operating margin 65%. So I'm just showing you how robust the Rainbow project is. Another key thing about the PEA that we've been able to demonstrate is that we can successfully apply this process flow sheet to phosphogypsum, and that's opening up other opportunities for us to secure other projects. You'll see that we made an announcement in June this year where we signed a MOU with a large diversified chemical company in South Africa to look at extracting the rare earth elements out of their phosphogypsum stream. What's significant about this is that their phosphogypsum stream is the exact same, uses the exact same feedstock that was used to create the Petroleum phosphogypsum stacks. So we know it's got a very similar rare earth basket, which is very high in NdPr, two of the key magnet rare earths, and also of a decent grade in the phosphogypsum. So that's a significant opportunity, we believe. And we also signed a master agreement with OCP in Morocco in August, and that's also very significant because it gives us country diversification, further project diversification, and it's also with the largest phosphogypsum and fertilizer producer in the world and phosphate acid producer in the world. So we think these two other opportunities are very exciting for Rainbow, and we will be applying a large part of our flow sheet that we've developed at Petroleum. We'll be able to apply to these other opportunities. Just to look at our business model as it's evolved over the last 2 years, is that we've got a strong focus now on looking to recover rare earths from secondary phosphogypsum sources, and we don't have a lot of the costs associated with hard rock mining rare earth projects, which you've got drilling and blasting, haulage of your ore to your process plant, then you've got crushing, milling, flotation, and so forth. A lot of the other costs that we don't have in our project at Palabora and other projects that we are pursuing. Just to take your viewers to the rare earth market, some of those viewers who aren't au fait with it, is that we know that at the moment the strong demand for rare earths is structurally driven by government legislation and 2050 emission targets that have been set out by COP, and by the COP conference held last year in Edinburgh. And basically, wind turbines, which are being rolled out as quickly as they can be put up right now. There are many gigawatts in the pipeline of wind turbines, and also being driven by emission controls on electric vehicles. So as you know, by 2030 in the UK, you won't be able to buy an internal combustion engine vehicle. And a lot of the car companies will also stop making internal combustion engine vehicles by 2030. I think France is 2035. Some other European countries are 2040. But over the next 20 to 30 years, there's legislation driving demand for these rare earth magnets, which will go into all these devices, including wind turbine, including drones, electric scooters, electric motorbikes, your cell phone, all use permanent magnets. And the key components for permanent magnets are neodymium and praseodymium, and to a certain extent, terbium and dysprosium. Unfortunately, at Palabora, we have all four of these rare earth elements in significant quantities, which makes our flow sheet very economic. I must stress that 95% of the value of our rare earth basket sits in those four rare earth elements, so also very significant. So, as I said, we see a big supply-demand deficit growing, and if you look at all the forecasts from people a lot cleverer than myself, are all forecasting rising demand for NdPr and also for rising prices, from here on until 2030. Another key thing for the viewers to understand is that China still controls about 80% of world's rare earth production in terms of mineral concentrate, but they control 90 to 95% of downstream processing. This is where you take your mineral concentrate and you do further beneficiation to turn it. Initially, you have to crack your mineral concentrate. Then you have to produce either mixed rare earth carbonate or mixed rare earth oxide. Then you go and perform the next stage, which is to separate these individual rare earths into separated rare earth oxides. And then you go one step further, which is to produce a metal and an alloy. And once you've done that, then it becomes feedstock to a magnet manufacturer. So there's still many steps in the rare earth processing supply chain that need to be developed in the West. And at the moment, we hope to be one of the main suppliers of separated rare earth oxides to that developing market in the West. Just a quick look at our resource. As one can see, we've got, that's our resource update. We're in a town called Palabora in South Africa, which has got a huge mining infrastructure. We're literally within 2 or 3 kilometers of the center of the town. We've got all the infrastructure on the site because our site's a mothballed phosphoric acid plant that was owned by Sasol. And on that site, we have warehouses, laboratories, admin offices, engineering workshops, and so forth, and electrical reticulation, all as part of the site that we have secured, where these gypsum stacks are that Rainbow have secured with basalt phosphates in South Africa. We also have very, very skilled labor force on our doorstep. The 3 operating mines still in Palabora, and we've got a lot of OEMs around as well. So original equipment manufacturers, for instance, Wyoming, we're one of the biggest suppliers of process plant pumps in the world, has got a depot 800 meters from our front gate. So this just gives you an idea that we are very well serviced from labor, from reagent suppliers, and from equipment suppliers right on our doorstep. And we don't have the problems associated with trying to build a mine in the middle of the jungle or in the middle of the outback, somewhere else in the world. Just to to once again reiterate how Rainbow stacks up against some of the other projects in the world. As I said, these phosphogypsum stacks, because there's a very, very low mining cost, or it's almost nothing, that we need to compare ourselves to ionic clay deposits. Ionic clay deposits also have historically very, very low mining costs. And compared to ionic clay deposits, we're 5 to 10 times higher grade. But very importantly, our NdPr parts per million is exceptionally high compared to ionic clay deposits out there in the world. The next closest one is we're still 600 times higher in ppm, parts per million, of neodymium and praseodymium. And then you have a look at the hard rock deposits out there. We still stack up very favorably against some of those hard rock deposits. And very importantly, if you look at our uranium and thorium content, we're exceptionally low. And in fact, you'll read in our PEA that we are below 1 becquerel unit, which is a benchmark for radioactivity. Now, the benchmark for radioactivity to ship on the high sea or to export into China, for instance, is 10 becquerel units. So we're below 1/10 of the benchmark. And there's effectively more radioactivity in your microwave oven than there is in our Palabora gypsum deposit. So it's another very big positive for this project. Once again, we look at the robust economics. So life of operation, 14 odd years. We will be treating 2.2 million tons per annum of this phosphogypsum on these 2 residue stacks that we have at Palabora, and we'll be producing 26,000 odd tons of rare earth oxides over the life of the project. The capital costs are $295 million US. Once again, conservative capital cost. We'll be looking to optimize this in the next stage of feasibility study, and our operating cost is exceptionally low per kilogram of separated rare earth oxides compared to any other project out there at the moment. If you look at once again the pricing sensitivity in our financial model, once again we've been very conservative. Our base case is based on 2023 numbers, which are below the year-to-date numbers for rare earth pricing. And if you look at the forecast at the moment, as I say, you can see we've got an NPV of over $1 billion. We've got a EBITDA margin of over 80%, and we've got a IRR of over 44%. So very, very strong numbers on the forecast, and exceptionally strong numbers on the base case as well. So we're very positive that we can survive even from this level, which the market is not anticipating. The market's already come down in pricing from the peak around about February this year in rare earth pricing to where we sit now. But we could see substantial reduction in rare earth prices, and Palabora would still be a very profitable project, which is de-risked this project, I believe, for investors to a large extent. That's just cumulative cash flow over the life of the project, which Donald has alluded to earlier. Once again, if we look at the sensitivities to OPEX, CAPEX, and the RAND, and we've used a very conservative RAND exchange rate as well, and you can see our project stands up very, very well under all scenarios, which once again, it reinforces my view that this project can see significant reduction in rare earth prices. Even if rare earth prices halve from here, we would still be highly profitable as a business. One of the reasons why we can sustain this is because of our very low operating and our capital cost base. And in this slide, you can see what a typical hard rock rare earth project needs to do before it gets to your final stage of beneficiation compared to Palabora. We're just going to what they call hydraulically mine the gypsum residue on the 2 stacks, which is using big water cannons. You normally have got hard rock mining, you've got drilling, blasting, hauling. You then got stockpile, you've got crushing, you've got milling. You have you're going to have flotation, which also requires reagents before you produce a mineral concentrate. Then you're going to have to crack that mineral concentrate into chemical form, and then you can start going downstream to produce a mixed rare earth carbonate or a mixed rare earth oxide. And then and most projects don't go further than that right now. Only a very few projects are going further, which is separated rare earth oxides. And one of the key reasons why we're fortunate at Phalaborwa is that at Phalaborwa, the chemical stacks are actually in cracked chemical form already. So that's a big advantage to the project, because with the production of this in the phos acid plant, you took hard rock slurry from the hard rock mine next door, phosphate hard rock mine run by Phoscor next door, and they used a flotation process to produce phosphate slurry, and this was then fed into a sulfuric acid plant where you added a phosphoric acid plant, where you added sulfuric acid and heat, and those are two of the key costs and ingredients that you need to crack rare earths into chemical form. And this has taken place for us already at Phalaborwa. There's the flow sheet. I won't go into much detail now, but at your leisure, you can go to our presentation. It's on our website. You can have a look at the flow sheet. And if you look at our PEA document, there's a huge section on the test work and on the description of this flow sheet to give you for the market to understand exactly what Rainbow have been able to achieve here. One of the key things that we also have low capex and low opex is that to go to separated rare earth oxides, we have this unique KTEC IP, which is continuous ion exchange and continuous ion chromatography, which they developed starting with continuous ion exchange in the 1980s. So these guys, this is not new technology. Continuous ion exchange, for instance, is used in all modern uranium plants. Myself and my team at Rainbow have built 2 uranium plants in our previous careers. So we understand materials of construction, and we understand this technology. And then continuous ion chromatography has been developed by KTEC some 20 odd years ago, and it's used in a number of industries, including biotech, mining, chemical industries, and they are located all around the world. And the photograph you see there of one of these continuous ion exchange modules is that module is actually larger than what we're going to require at Phalaborwa. So our flow sheet is very scalable. In fact, what we are going to be building is in fact smaller than the biggest commercially available units in production or being used in production right now in one of the plants that KTEC has designed. So that once again gives us lots of confidence in our flow sheet. Basically, on the back of these very strong results, there you can see a photograph of the KTEC laboratory in Florida, where they've tested and proven this flow sheet at length, and they continue to do optimization between now and the end of the year. Even though we completed the PEA flow sheet, there's always optimization in flow sheets that takes place, and we'll be optimizing right through to the end of the bankable feasibility stage. So basically, our next steps are we're going to come out with the resource update. We're going to go into our full feasibility study. We'll be updating the permits that are in place, and to make sure that we've got our ducks in a row with regards to permitting. This is a brownfield site, so lots of permits already in place that we were required to operate a chemical plant on the chemical processing site, but there will be brownfield amendments to these permits, and we will be requiring a new permit for the new stack site, which will be aligned to IFC and equated principle standards, which is reducing the environmental liability that sits with these 2 gypsum stacks. So this is a very big ESG project. We're cleaning up a big environmental liability because these stacks have got a lot of acid water associated with them. We'll be neutralizing that acid water and using it in the closed circuit in our rare earth processing plant at Phalaborwa, and we'll be redepositing a benign gypsum on a new stack site, which, as I said, will be to IFC and equated principle standards. And of course, that will be a whole new permit application, but it's a permit application that's basically cleaning up the environment. And so we don't foresee any problems there. And then lastly, we will be embarking on a pilot plant operation to extensively pilot the flow sheet to further reduce any risk that we might have not foreseen with developing this flow sheet. But it has been tested at lab scale. We'll now be doing it in a continuous larger scale pilot plant on site. And that's one of the key stages we'll be doing next. So to finish off, we think Rainbow is, unbelievably well positioned to unlock this the opportunities for the green revolution, and that is recovering rare earth oxides from secondary sources, which makes each of those projects a good ESG story. We've got a very robust PEA. We took a long time developing this PEA in terms of the flow sheet. And the reason is because we wanted to get it right. And as I said, if you look at the CVs of our team, we've got a large background of experience in developing projects, designing process plants, and building them. And we wanted to make sure that we came out with the best PEA possible, and I believe we've done that. And we have very strong investor support from a strong institutional base, and we believe that will continue going forward. So thanks very much to the viewers for your time, and hopefully this has been very informative to you all.
It has indeed, George. Thank you very much indeed. I think we have to pause for a moment and say congratulations to you, because you've come a terrific distance in just 20 months.
Yes, we have, but we didn't start at a zero base. The Palabora gypsum stacks have been subject to research by Mintech, the well-known mining laboratory in South Africa, for 20-odd years. So we had that whole body of knowledge that we're able to draw on, plus Sasol themselves, some 12 to 15-odd years ago, did a whole lot of research on extracting rare earths from the phosphogypsum at Palabora. And in fact, they built a pilot plant on site, a bulk pilot plant, which successfully extracted 3 tons of mixed rare earth carbonate from their phosphoric acid solution at Palabora. So we always knew we could extract the rare earths from the phosphogypsum. It was now just a matter of tweaking this flow sheet. And as I say, so we've achieved a lot in 20 months, but there's a lot more. And then very importantly, KTech bring to the party with Rainbow, and we've certainly selected the right partner there, over 30 years of phosphogypsum experience in Florida. Florida is the center of phosphogypsum mining and phosphogypsum stacks in the USA. That's why they're based in Florida. And we're able to draw on their 30-odd years of experience. And when I say 30 years of experience, not that the company is 30 years old, but the original principal founders of KTech are still there at the company. So all their IP that sits in their head, we've been able to draw on. And they've got over 50 patents globally to their name for extraction of various process routes for various substances, including phosphogypsum. So we had a big body of knowledge to draw on and to help us develop where we've got to. And as I said, the front end of our flow sheet is now subject to a patent application jointly between KTech and ourselves. And this is opening up the other opportunities that we've seen Rainbow start to open up, as I've mentioned, with what we've signed over the last couple of months with other opportunities in other countries.
Okay. Perhaps we can go through this fairly quickly. Resource update. When do you expect, in terms of news flow, when do you expect the resource update to come next?
A resource update will be in the next 4 to 8 weeks, I would say.
Oh, quite soon. And the full feasibility study, when might we expect that one?
Well, no, we've just finished the PEA, Donald. You have to give me time to breathe.
You don't breathe, George. I just listen to you present.
We have to scope out exactly the feasibility study. We have to select an engineer to do that, because we used a very good engineering firm for the PEA. But like anything, it'll have to go to commercial tender, and then we've got to select the engineer, and then we've got to see what their schedule is. So as soon as we have that schedule, I will update the market. But at the moment,
Q2 of next year, possibly.
No, you can't do a full feasibility study that quickly, Donald. You've got to do these things properly.
Back end of 2023.
At the back end of 2023, we should be complete a full definitive / bankable feasibility study.
Fantastic. No, that's very helpful, George. Really helpful. And permitting for the stacks, the two stacks, gypsum stacks.
It's just one stack site. It's just one stack site we have to permit, and we've already highlighted that as a critical path item for Rainbow, and we've started work on that already.
Okay. As you say, this is a low cost return project with capex costs of around 295 million. So are you looking at a mix of debt and equity to fund this? And what kind of discussions have you had so far around this with banks and
well, we had to get the
other
PEA
interested parties?
We had to get our PEA out first before we can go into hard discussions. But now that we've got firm numbers, we can start these discussions. We anticipate circa 70% debt and 30% equity, but that's still some way off. And we've got a lot of work to do. We know the project's very robust. We know with these kind of numbers and this payback period that this is very financeable. And we've had approaches from a number of debt financiers to have a look at financing our project. So we're not short of people who are knocking on our door. And now that the PA, this was before the PA was launched, and even now that the PA has been published and people can see exactly how good these numbers are, I think we'll have more people knocking on our doors over the next few weeks.
So the PA just unlocks a whole lot of interest, do you think?
Correct.
Oh,
I always said that this would be an inflection point for the share price and for the market to start re-rating the share. And I think if you look at the risk profile of Rainbow, look at the opportunities, we're not a single rare earth project company, whereas most rare earth project companies are single projects. So you've got a huge amount of risk with that. We've got multiple projects. We've now got country diversification. And I think that's quite unique in this space. And we've got a way of still becoming, when I say still becoming, each project we're looking at is going to have very, very similar low operating costs, and each of those projects will be able to deliver a very, very low cost for separated rare earth oxides,
okay,
which I think the Western world's looking for.
John, talking about the Western world, John Bryant says, you said that the final stage processing of rare earths is still concentrated in China. Where is the capability being developed in the West to take the oxides that Rainbow produces?
Well, that's a very good question, because right now there's very limited capacity in the West for separated rare earth oxides. That has to be built out. We've got the EU, the UK government, Canada, the US, all making lots of noise about having independent supply chain outside of China, but they've got to then make sure that the downstream beneficiation gets given support and actually starts being developed in the West. If you look at a big rare earth concentrate producer like Mountain Pass, right now all their concentrate, and they're the biggest mine outside of China, even bigger than Lynas in terms of concentrate production, all goes to China. They still haven't got their downstream beneficiation done at Mountain Pass. And even if they were able, and I know they are busy retrofitting their process plant in Mountain Pass in Nevada, that once they get to a separated rare earth oxide, there still aren't the magnet manufacturers in the US that have been built yet. They can take it, so that has to be built out. So
is that a source of frustration for you?
Well, we will be a supplier of separated rare earth oxides, and we will sell it to where the market is. We hope that market is going to be developed in the West, and we are supportive of that. But in the short term, by the time, and because we're very near-term production compared to most projects, in the short term, we'll probably have to have offtakes with Chinese downstream players until the West can develop it.
Very good. You answered two questions in one there. That was very clever. Mark Proudfoot, last question. Remind us, when is first revenue? I think it was in the RNS, so I think he's apologizing for asking a question that he should know the answer to. When is the first revenue expected?
Well, if things go to plan, and as I said, The team we've got at Rainbow has built a lot of process plants on time, on budget, I might add, as MDM Engineering. We are targeting to be commissioning in the latter part of 2025 and full production 2026.
Fantastic. George Bennett.
Now, most hard rock mining projects, be they rare earth mining, gold mining, or whatever, your cradle to grave, which is when you start with the project, you initially get it to production, averages between 10, 12 to 20 odd years.
Fantastic. We're out of time, George. I do apologize. Thank you so much for coming to us from Johannesburg tonight. That was absolutely fantastic. Oh, I need to go and have a cup of tea after that and calm down. It was so much information in there. George, that was terrific. You did really well.
Okay. Well, thank you for that. And hopefully the viewers understood it and they took note. I've delivered on what I was...
You've been telling them a story for quite some time. You're just putting a lot more numbers and so on and detail into it. So yeah, I'm sure they do get it.
I've delivered the numbers, you know, even better than what I've been indicating for some time, you know.
Even better, and you were indicating good numbers.
Yeah. So let's hope we continue to see positive reaction to it, Donald.
Oh, I'm sure you will. Our final guest speaker this evening is Stephen Keith. And he is the CEO at Labrador Uranium, who are listed on the Canadian and the OTCQB stock exchanges. LUR are undertaking a drilling and exploration program on their 139,000 hectare CMB or Central Mineral Belt property in Labrador, Newfoundland, which, as we all know, is in Canada. You knew that, didn't you? And there, you probably don't know this, they're using machine learning to analyze 50 years of historical mining data from the area, which all sounds very clever, and I'm intrigued. I want to know more. All against the backdrop of rising uranium prices in 2021 and 2022. I do believe we're at a 10-year high, give or take. So the FT said in the middle of September. So uranium's pretty hot at the moment and potentially about to hit a super cycle. We're delighted to welcome Stephen Keith, CEO, and he's speaking live. Where are you speaking live from, Stephen?
Toronto, Canada, Donald.
There's only one place in the world, Stephen, and that's Toronto, Canada.
Well, we like to think so, but sometimes I'm proven wrong.
I can't believe there's anywhere better than Toronto.
Well, you know, come on over. I'll tour you around.
Fantastic. I'm on my way. All right, Stephen, over to you.
Well, thank you, Donald, and thank you, everyone, for joining us. So, look, I'll walk you through the story. I'm going to do it relatively quickly. I find the best parts of these sorts of fora are the Q&A, so I want to make sure that we get there and give people enough time to ask some questions. So I'm actually going to look at my phone as I'm doing right now to set a timer such that I do not offend anyone on the timing. So look, Labrador Uranium, we're a new company. We were listed only in March of 2022, so we're not even a year old. We're listed on the Canadian Securities Exchange, but we're also listed OTCQB in the United States and on the Frankfurt Exchange. We are, as the name is fairly clear, we're focused on uranium exploration. We have taken control of a district-scale target-rich mineral belt in Labrador, Canada, and with that comes about 50 years of historical information. This is a belt that has been looked at for decades, first for copper, more recently about 10 to 15 years ago for uranium, and some significant uranium discoveries were made in the last uranium cycle. But we, in the intervening time, with some of our partners, have put together and consolidated this massive belt that for the first time is in a single hand. And that is basically what we're looking at. So I will be making forward-looking statements. So, you know, please have a look at this disclaimer to make sure everyone's comfortable with it. And I'll launch into it. Look, I always like to start these things by looking from a 30,000-foot level and drilling down. So I always have to ask the question, why am I investing in this company? And look, uranium is an exceptional thing, but let's start with the most important thing as far as I'm concerned, which is the people. And as much as I want to say that's me, it's really about the entire team and the board of directors. We have a group of established company builders here. As you'll see in a second, our board of directors is made up of individuals who have built companies before, done very well by their shareholders. We have a long track record in uranium as well. So when we built Labrador Uranium, it was actually a spin out of Consolidated Uranium. We took their Morin Lake asset out of Labrador. That is an asset with historical uranium and vanadium resource that we plan to grow. But with that, we also did a deal with Altius Minerals. Altius is a very successful group of asset generators. They're also a royalty company. And they put together about 139,000 hectares of land in the central mineral belt. Again, a region that has been explored for 50 years. So we've got Altius that we're working with, Consolidated Uranium, and we also bought an asset from Mega Uranium. We do have a track record of creating not just companies, but value for shareholders. And yes, we do have this group on the board that understands the market and how to build companies and protect shareholders. But more importantly, we are an exploration company. So we have built this out with an exploration focus. And we've got a great team that I'll look at there with deep experience, though, in uranium and in Labrador specifically. We do believe that this is Canada's next great uranium region. Why do we think that? First and foremost, in the last uranium boom, Aurora Energy was, well, they've now been bought out by Paladin, made a discovery of a greater than 100 million pound uranium project on the eastern end of this belt. So at the very east end of this 125 kilometer long belt that we control is a greater than 100 million pound uranium deposit. So that's Paladin. And they've started work there again this year. I think once they got the Langer-Heinrich project up and running or the development of it moving forward, they started to focus here again. So they're doing exploration here. We have uranium on our Morin Lake project. That is a known historical resource. And in between those two, so over 100 kilometers, there are dozens of clear uranium, but also copper, IOCG known occurrences. When Altius put this package together before we took it over from them, they had identified 146 targets that were worth looking at. So that is historical data, geophysics, grab samples, drill samples. We know that there is mineralization here. It's a very exciting place to be. And again, we do start with a historical resource. And then you know, it's always nice to be in the middle of something great. This is a really good, well-timed opportunity. Uranium is moving very quickly. There's a global shift towards this green economy, and uranium is going to play a fundamental role in that. And we will offer great exposure to that and what we expect to be not just a single project, but multiple projects. And I'll walk you all through that. So we'll go to the next page here. Very brief company snapshot. Today, we're sitting around 58 million shares outstanding. Cash balance sitting around 14 million. At the end of the year, we expect to probably still have over $10 million in the bank. So we're in very good shape as an exploration company, not just to do the work we want to do this year, but to move this forward next year. We've got an exceptional group of shareholders. So even before we went public, we raised $10 million, and in total, between creating the company in October of last year and our listing in March, we raised about $20 million. We did that mostly through long, like uranium-only institutions, like big, large believers in the uranium boom. We have a great retail base that came out of spinning out the shares for the asset we bought to Consolidated Uranium. Mega Uranium is a strategic holder, as is Altius Minerals. It's a really good group of people. And we've already got some research coverage out there. We think it's a great start. I think people, you know, look, we are an exploration company. We are not going to have a mine built here a year or two from now, right? So we've really got to focus on making discoveries. We have money, we have property, but our job now is to make discoveries. And how are we going to do that? So on the board side, that's the side that's going to protect the money, develop the strategy, and make sure we do the right things for our shareholders. Phil Williams is our executive chairman. He's also the CEO of Consolidated Uranium. That was where we came out of. Richard Patricio, CEO of Mega Uranium. Again, both of them are very long uranium. They've been in the space for quite a long time. Actually, when I was an investment banker, Phil was the research analyst at the bank who was covering uranium. What was that, 2010, I guess. So, and then we've also got Justin Reed on the board. For those of you who don't know Justin is the CEO of Troilus Gold. He has run several public companies before, and oddly enough, he and I actually were both running fertilizer company in Brazil at the same time around 10 years ago. And then Brigitte Bernesh brings not just a financial acumen on the accounting side and someone which is very important to us and to any board. She also brings independence, which is critically important. But most importantly, we need to make discoveries. And how are we going to do that? Because of the nature of these assets, we've looked at exploration from 2 points of view. Firstly, we have the hard on-the-ground exploration. That's being run by Nancy Normore. She's our director of exploration. She's worked for over 18 years in exploration. We pulled her out of Voisey's Bay, so she's got deep experience in Labrador, but she's also worked for quite a long time in uranium exploration. She's out there in the field developing our program with Matt Melnick helping her out. He's our consulting geologist and QP, and he's had dozens of discoveries under him. But the other side of this is really important for us to focus on is we do have over 50 years of data in this belt. All these properties, and you'll see how broken up it is in a second, all these properties have been in dozens of hands. So no one has ever looked at this as a singular project before, a singular piece of land, and we can. So we've been able to pull out that 50 years of data, look at this land package in a way no one else has. And what we're doing is we're building our own internal machine learning program, so artificial intelligence, in order to go through all that historical data to come up with some very clear targets. Because we have so much land and so much work to do, this is going to make that a lot shorter and easier for us. And we have the experience. So Paul Pearson at the top of the list there, Drew Heisman at the bottom, both of them, lots of experience in geology, in the field. You know, Paul's been at this for 35 years, Drew for 15, but just as importantly, they've also been working in machine learning. So Paul won the Galler Prize several years ago, which was looking at applying machine learning and artificial intelligence to exploration and discovery. Drew Heisman and his team won an award at this year's PDAC, an Emerging Explorers Award, again, for doing the same thing, applying machine learning to exploration. And we think that that's going to provide a massive advantage to us in this huge area that we have. So look, Labrador is a terrific place to be. Newfoundland Labrador is considered the 8th best place to invest in mining in the world, according to the Fraser Institute. There are world-class large-scale mining operations in Labrador already. So the Voisey's Bay project in the north there, most people are aware of it. It's got to be one of the richest nickel deposits in the world. That's being run by Vale. In the province as well, we've got things like Rio Tinto's Carol Lake iron ore mine. There's a lot in this area. It's quite resource rich. It's very friendly and it's very politically stable. So this is a great place to be. And as we look at global geopolitics, it's even a better place to be relative to a lot of the jurisdictions people are looking for uranium. And uranium for me is a fairly, look, I try to look at things as simplistically as possible from a supply and demand point of view. I've worked in the uranium sector, in the exploration sector, in the development sector for a long time. I've also worked in renewable energy for quite a while. I'm a fan of renewable energy. The trick is this: run-of-river hydro, solar, wind, those can only provide energy, 33% of the time from the majority of those projects. You can't fire industry or cities off of that kind of availability of power. So we need baseload power. But if it has to be clean, what is our choice? And the only real choice today is nuclear power. And it's moving. China is building dozens of reactors. The EU has declared nuclear energy to be a clean, green energy. More than 50% of the American green energy mix is nuclear. It continues to grow. We're looking at a situation where we're going to almost double nuclear capacity in the next 10 years or so. And we need to find uranium. Here in the Central Mineral Belt, we have uranium. We've got much more than that too. The entire belt's about 260 kilometers long. We control 125 kilometers of that. It is the junction of 4 major geological belts. What has that done? It does 2 things for us. It has brought many of those fluids to surface that bring your coppers, your gold, that sort of thing into the system. But also you've got those structures like from that faulting and folding that's occurred, again, 4 different mountain building phases. And that's where you're getting the traps for the uranium. You need traps for uranium, and we have that. And that's been proven because, once again, we have Paladin's 100 million pound plus Michelin deposit. We've got our 20 plus million pounds of uranium equivalent at our Morin Lake deposit. And there's multiple other projects that have been identified in between. So this is a really mineral rich belt. It's important to also remember the first sort of 30 to 40 years of exploration in this area was in copper. There are dozens and dozens of copper showings along this belt that we have. And if you look even at our historical resource at Morin Lake, that comes with a vanadium resource as well. So this is mineral rich, but it is a big piece of land, and we've got to figure out what to do with it. We do have this dominant land position. So if you look at this page, you can see those lines. This has been multiple claims in multiple hands for 50 years. We've put it all together. And what I want to draw your attention to is every one of the black dots on that page is a known uranium occurrence. And so we own everything that's colored in here. Here's Paladin's Michelin Lake deposit, and they've got Jacques Lake over here. This is our Mustang Lake project. Our Morin Lake project is this red star here. So again, about 20 million pounds uranium equivalent. But all of this here, northeast and southwest, are clear uranium showings. That looks really exciting for us to keep and continue growing these resources till it becomes something more meaningful. But it's a really exciting area to be in. And, you know, this just sort of hits that point on this page here. Again, is every one of these white rectangles points to a known uranium occurrence, including several known deposits. So that's what we control. And now we have to put this or make the discoveries such that these can be economic deposits. Michelin probably is one already. The economics haven't been done on it, but Paladin is now starting to do work there again. Morin Lake is looking really good, but we do have to grow that. At the present size, it's not good enough, but we do believe we will grow it. And this page here is also quite exciting. So here on the left, how are we doing our targeting? We've got all this historical data of the mineral occurrence, what's happening in the water, the geochemistry, the historical drill holes. But what I want to point to is this. All those green dots here on that map are the known uranium. So, but what's also just as important is look at all those red dots. Every one of those red dots is a known copper occurrence. So you see these parallel structures. If you were to look at this geologically, there are huge structures that underlie this from which a lot of this comes from. So the potential of making many more discoveries or finding more projects is really exciting here. But once again, our job now is to put that money in the ground to make those discoveries. But other than that, we are also applying this modern data-focused approach. That modern data-focused approach, what is that? It's machine learning. We have 50 years of data. We've got to learn what to do with it. So how do we process that data, clean it up so that we can enter it into the machine to do something with, but more importantly, or as importantly, we have to teach the machine what it's looking for. The nice thing is we have models in this basin already, again, like Michelin and Morin Lake. So we can already see what, from indicator minerals, the types of structures we're looking for, to ages and geology, the different geophysical patterns that this shows. And so when you combine all that historical data with knowing what's controlling these deposits, both here and elsewhere, what will come out of that? And it takes time because it's a lot of data to crunch. But what comes out of that will be specific targets and what we're calling projects. So refining 146 known targets into known projects. It's not going to be 146 projects. That's crazy. But a lot of those are in a certain area. If you recall that map here, it's where these clusters occur that you might end up having a singular project that could be a mine in the future. And that's what we're looking for. And we want multiples of these, and do believe that that is what this basin has. So we start with Morin Lake. It's a known uranium deposit. There's both a uranium and vanadium resource here. It is open along strike and at depth. Not that we want to go too deep. Why? Because the grades of this, one thing to really realize when you're looking at uranium, look, there are operating uranium mines in the world at under 200 parts per million uranium, right? So we're sitting at 300, 350 parts per million, very similar to what they're mining in places like Namibia as well. But at these grades, you don't want to be going too deep. So we're looking for shallow projects, things that come to surface, that hold together nicely. So we're testing this along strike, we're testing this along dip, and hopefully looking to grow this. And then the questions we're asking is this a singular deposit that grows, much like what Aurora did and what Paladin did with theirs, taking it from 30 million to 100 million pounds? Is it a single deposit or multiples? And you'd have to apply a hub and spoke model, again, much like what they're doing at Michelin. We will see, but we know that this is here. We know that it grows, and now that's what we're focused on for now. And this year's exploration program has been focused here. So there's our field camp. It's our inaugural camp. So remember, we only listed this company in March of this year. So, and Labrador has a very set exploration season for where it is. So you're looking mid-July to mid-October. But having listed in March, we were able to get our permits from both the provincial government and the local Indigenous government. We were able to get our contracts and our team out there and start that exploration work. We've already identified 3 areas that we're really excited about. So this red star here is the Morin Lake project. Well, that red oval is where we think it extends to and where we're going to be exploring to grow that asset. Up in the northeast, there is the Anna Lake project. Anna Lake itself is a small deposit owned by a third party. It's about 5 million pounds of historical uranium. But all around that are incredible showings of copper and uranium throughout that entire valley, and we control everything around it. So it looks like something is coming together there. And then Mustang Lake over here is a deposit, is a project that it's straddled by Michelin and Jacques Lake, and it's the exact same rocks at depth, and uranium has been hit in drill holes there historically. So that's what we're looking at now. That Chalks Lake camp is our existing camp where we're flying out of. And you'll see in the bottom left here of this map, of that inset map, where we're looking at. So we've got not just uranium targets that we're drilling and exploring, but we've also come up with some targets for iron ore, copper, gold, so IOCG. We were expecting that both because of the structure and the type of mineralogy we're seeing, but we're really excited to get in there and start drilling that. And that's the first fruit of that machine learning program. And something that's worth talking about just a little bit here is we are uranium. We talk a bit about IOCGs, but one thing to remember is IOCG projects can be very exciting for uranium. One of the world's largest uranium projects, if not the largest, I know it's close, is Olympic Dam in Australia, which is an IOCG project. So this is not against our goals. It actually fits really nicely. And again, if we're not looking for a single deposit, we think and hope that there are multiple deposits in this region. And that's what we hope to put together. So Mustang Lake, I gave you a bit of a summary there on the last page. This is hit over 9 meters of uranium mineralization downhole in the same rocks as you see at Michelin and Jacques Lake. We'll be doing some geophysics there this winter and getting that ready for drilling next year. We also have Morin Lake, like I talked about. And this is what we're trying to do. So Aurora Energy, when they had Michelin at the beginning, had a very similar story to ours. We're starting with the 20 million pound historical resource. They started around 30 million pounds. Altius Minerals is one of the groups that put that asset package together. Same with what we have here was done by Altius. And what you'll notice is this thing soared. This thing went to $1.3 billion in market cap. Every drill campaign they had continued to add pound after pound after pound of uranium. And it helped that the market price went up of uranium in that time. However, what's also interesting is, yes, when uranium went down, so did the company's value. At a certain point in time, and it has been lifted, so we don't have to worry about it anymore. But while the Inuit were working on self-government, there was a moratorium in uranium in this region. So that did tank the stock of Aurora at the time. But even with the moratorium on uranium at the time and the sinking uranium price, Paladin bought this thing for $261 million. So there's very real value in the ground. And now they're back in this area, having worked out what they're doing in Namibia with Langer Heinrich. They're now starting to spend money again in this region. And we think that we're going to see a lot more come into this basin. And it's a simple story, and it's exactly the sort of thing we're trying to do, but we're actually trying to do it on multiple fronts. We're hoping we have more than one deposit and that we can continue to do this. I'm not going to spend time on the next 2 pages other than to say, other than this huge land package that we have, that with all these exciting targets, there is another project that we have up north of us called Nataquanon. It's very new. It's a very new discovery. It's a new belt. We're not spending a ton of time on it now, but it is exciting in that it has 22 occurrences of uranium. The uraninite veins come right up to surface. The grades look really good, but no modern exploration has really been done here. All we know is that there's a lot of uranium in the system, and it merits some spending and some exploration work to be done. So look, we are less than a year old. In that time, we put together almost 140,000 hectares of land. We've generated over 140 uranium and IOCG targets, 70% of which are ranked high to moderate probability targets. We started our inaugural drill program, so we're out there drilling right now. We won't get as much drilling done as we'd hoped just due to weather and things like hurricanes, and the machine learning is already starting to generate results and targets for us. So as we move forward into next year and beyond, we're well financed. We're going to close this year out with more than $10 million in the bank account. We're listed in the US and in Frankfurt as well as in Canada. We've got a great shareholder base. So as I like to say, now our job is to just do the work. It's a professional geological group. We've got to put the money in the ground. We control a district scale of a well-known multi-commodity metal belt. We have a historic resource base that we can grow from with lots of discovery potential in and around that. Really good shareholder base, and it's led by a proven team. Like both the board and the geologists that we have had a great track record of building companies and making discoveries. So now we just want to make this as simple as possible. Put the money in the ground and make those discoveries. And that's where I'm going to leave it, everybody. I'm going to stop sharing and hand it back over to you, Donald, and see where we go from there. Thank you.
Okay, Stephen, thank you. My goodness, that was interesting. And you said beforehand that you can talk, and you certainly can talk.
Did I miss my time target?
No, not bad. Not as bad as everybody else tonight. Yes. Okay, let's start with the uranium supercycle. Are you a believer? Do you think within the next 2 years that uranium will demand will exceed supply significantly?
I really do, actually. Like if you look at the statistics of what's coming out of not just China, right? You're looking at dozens of reactors being built there. You're starting to see Japan look at nuclear reactors again. The US is putting money and strategic money back into nuclear reactors. A lot of time and efforts going into small modular reactors, which will open that up globally because it makes people feel more comfortable. And again, if we are going to go carbon neutral, there really is no choice, right? This battery revolution is very exciting, but you have to charge a battery. Where is the electricity coming from? It can't come from coal, can't come from oil and gas. It's really hard to build large hydro nowadays, right? To get that permitted. Nuclear really is that thing. And if you just look at the stuff that's in development now, and these might be a little out of date, but the numbers I look at is 19 reactors are under construction right now. Over 40 are looking at being permitted right now or in the permitting process, and over 150 have been announced. So we're looking at over 200 reactors that have been announced. We're looking at over 200 gigawatts of power. And then you add to that global geopolitics, right? Like we're getting our uranium from all these sources. Well, all of a sudden we start thinking, and I'm not trying to make my own judgment on this, but are we going to continue to buy everything from places like Kazakhstan, or do we want it from safer jurisdictions like Labrador? There's always going to be a hybrid. The majority of the processed uranium coming out of Russia, that has to change. So I am a big believer, and I think this has very long, very sustainable legs.
If there are 200 nuclear reactors in development or projected, where's the uranium? Where's the yellow cake going to come from?
That's the question, right? I think it looks like we're going to be almost doubling demand. And so we start with where are the nicest or sexiest projects in the world for uranium? That's Saskatchewan right now. If we're looking at if projects like in our basin have between 300 and 800 ppm of uranium, they have like over 1%. Those are super rich deposits. You don't see that anywhere else in the world. You can't build that many mines in one area. They're extremely expensive and very hard to develop and work, but that you will get stuff there. But then where else do you go? So you look at places like Namibia, Kazakhstan, Niger. Look, there's a lot of uranium in Niger. The French have had a lot of success developing projects in Niger. So I think we'll continue to see things like that. It's easily the scariest due diligence trip I've done in my entire life. So I don't plan on going to places like that. I like safe jurisdictions, and I like places that are easy to buy from, especially strategically. I think you do have to keep those things in mind. Okay.
Well, Mark Proudfoot says that you're interesting and that he wants to know more about you. So that's good. That's a success. You've got a follower. He's slightly cynical about machine learning, though. He says, how does a new company get the data to analyze? Let's break it down into parts. First of all, how does a company get the data to analyze? You've got 50 years of historical mining. Where did it come from? Did you have to buy it?
No, because almost all this, the reason we were able to get this is between the last uranium boom and when this land package was put together, mostly by Altius Minerals, most of those companies had walked away. So when the junior mining boom, uranium exploration boom died, sort of, what was that, 2012 or so, they couldn't raise money anymore. So people had to drop their land. And again, remember when the Nunat-Siavut government was being formed, so the Inuit were forming their own self-government. Between the point where they announced that self-government starting and the formation of it, they stopped all uranium work. So like the land was dropped and it went away, but that meant all that data becomes public data. So now we can have it all. So we were able to get, now you have to chase some people down. Not all the data is there. It's very complicated and some of it's just garbage, right? You need to be able to get it set up in a form that fits. And it is a bit of a nightmare to try to put everything together to fit because people sometimes use different grids and whatnot. But that is exactly why you need the individuals who know what they're doing. This can't just be, for lack of better terms, tech geeks who are just inputting data. You need to have trained geologists who know what they're looking at. They need to know how to train the machine as well. So what are the things that are controlling, say, a uranium or IOCG deposit? What types of structures we're looking for? What are the geophysical tells? What are the other tells that we're looking for geologically and whatnot? So you strip that data out of what's old, right? And you start inputting that in, as well as you know what's controlling these structures. That's what you're teaching the machine and telling it to look.
You have to have people inputting data who are pretty on it. It's not just
Yeah.
students straight out of university, is it?
No, and it's a nightmare. Like it is a lot of work. And a lot of the data is going to be garbage coming in, but it is also an iterative process, right? It's not some magic black box. So as we get data this year, we'll put more in because again, it's just such a huge area to look at. To try to prospect that as traditionally is almost impossible. But now that we can sort of look up from the table, everyone used to have these smaller pieces of land. We now have this huge piece of land. So how do we put it together? Okay, this geophysics exists, but maybe there's no large airborne gravity. So maybe next year we go and shoot a few $1 million of airborne gravity and see how it sticks together. Looking for these deep structures for the IOCGs. You know, there's a lot of ground cover here. So the uranium doesn't always scream at you. So what else are you looking for? So look, it's a very fair comment. It is not straightforward. It is not easy, but if you have the individuals and support to do that and know what you're doing, it can be exceptional. Seeing more and more people get into it. We're seeing companies have success with it. We've seen companies fail at it. Now, my suggestion is a lot of the failure was a lot of that initial stuff, as I said earlier, where it was more tech geeks getting data and try to push something out the other end. You really need the geologists.
Okay, final question. I'm sorry, we're genuinely out of time. It's been fantastic, but we are out of time. So one last question, news flow. This is part of your pitch to investors, really, because they're always looking for inflection points in the share price. What can we expect from Labrador Uranium in terms of news flow in the coming months?
So look, again, we're early stage, so we're not going to have any world beaters necessarily, but we do have a lot of news coming. So we're just wrapping up that inaugural field program. So we'll be getting the assays probably end of the year. We haven't shipped those out. Those assays are targeting not just the existing mineral resource, but trying to extend it. What we really want to look for isn't, now I'd love to find 100 meters of 2% uranium, but what we're actually trying to do is, are we seeing that Morin Lake, just on the Morin Lake drilling on its own, are we seeing that can grow? Because so that's the first set of results that we're doing, because that growth is what's important. That grade can be a mine near surface, but not at this size. It needs to grow. So are we showing that it can grow? And we do think we can show that. Are we showing that we're hitting uranium? Yes. The other thing that we're looking at is, what are the other commodities that are coming in with this? Not a lot of guys have looked at the copper that comes with this. And one of the things you got to think about is, if you're going to build a mine in an area like this, they're not going to be low cost. So can I juice my revenue by having one or two other commodities that are in high demand, like a copper or something? All of a sudden that lowers my uranium operating cost. Are there other things in great demand? So I think we're looking for some of that. So there's obviously the assays and the results of the exploration program. There will be an output on the machine learning with a more up-to-date map of new targets, not just what we've shown before, but saying this is why we think there's a project here and where our drilling will go. And then I expect, look, we've consolidated a lot of land in this area. There's a lot of historical work, and hopefully we can continue to consolidate that. We want to keep adding pounds and pounds of uranium to our book. And then we want to just grow this. We do believe this is a district. We do believe there are multiple projects. So that's what we're trying to drive. We need to be able to show investors that is coming. It will take a while to drill these out into significant resources, but the biggest thing to see is, are we showing that progress? And I think over the next few months, that'll be the key driver.
Okay, Stephen King, CEO of Labrador Uranium. I think we concur with Mark Proudfoot. You're one to watch. We'll put you on a watch list. Thank you so much, Stephen. That was fantastic. I just have to go through my thank you list now, really. I have to thank the speakers for being as fantastic as they were. I have to thank their support staff for getting them all there on time, more or less, and with slide presentations to deliver. I'd like to thank London South East team, who have been as fantastic as ever. Thank you, thank you, thank you. I'd like to say special thanks, on top of all those other thanks, to Red Cloud Financial Services, the Canadian broker who connect us with such high quality mining companies in Canada. You know, we've never heard of any of these companies, and they come along once a month and they blow our socks off regularly. They are just terrific and so interesting. So thank you very much to them. And if you want to trade in any of these stocks, then Interactive Investor is the place to go. They do TSX and TSXV, the larger and the smaller exchange in Canada. So finally, huge thanks to you all for having stuck with us right to the end. It's been fab. I hope you've enjoyed it as much as I have. Thank you for being such a great audience, and enjoy the rest of your night.